Let's pretend we're going to start a company. We will need cash to start the company, and so we're going to invest our own money. Our money, as the owners, is also referred to as equity. That's going to be represented by the ginger ale in this glass. Quite often that's not enough money to start a company, so we're also going to have to obtain a bank loan. The bank loan is represented by the orange juice in this glass and at that level. So right now, what we have is equity and a bank loan, but there's nothing on the other side of the balance sheet. So our balance sheet is not balanced. Credits represent the source where the money comes from, whereas the assets are represented, or the debits represented, are the destination, where the money goes to, what it's spent on. So in our case, we haven't spent the money on anything yet. All we have is cash. So we have our bank loan, which is cash, and we have our owner equity, which is also cash. So now on the asset side, we have cash. We can't easily tell how much is the bank and how much is ours. It's just all cash. So to start the business, we need to acquire some assets. So the first thing we need to do is buy a building for our business to reside at. So that will be represented by this glass. So the total value of the assets has not changed, but now we have less cash, and now we also have this new asset, which is our building. Now, throughout the year, the value of the building is going to decrease, similar to the way the value of a car would decrease. That's called depreciation. Also, throughout the year, we're going to have to incur other expenses. We're going to have to pay bills for electricity, for the building, and we're also going to have to pay salaries to any staff that we hire. That's going to come out of the cash account. Now in both cases, the value of the company has decreased, but our customers are happy with the products and services that we provide to them, and they pay for it in the way of cash. So now let's say that this is the end of our first year, and we want to find out, did our business generate any money? Did we earn more? Did we create value in our company? Now we can't easily tell, but if we put the value of the buildings in with the cash, now we have just cash. Our total assets is right here. So to then determine if we've made any money, we first have to account for the bank loan, and we know how much that is. And then the remainder of that is the equity. Now, if the value of equity is above the line, we've generated income. We've created value in our company in the year. If it's less than what we originally contributed, then we lost money. Now the important part of this demonstration is that the glass with the equity was always empty. That's because equity on its own doesn't really exist. What exists are the assets of the company and its debt. So let that sink in for a minute. Equity is just a calculation of your total assets minus your debt. It exists only on paper. The more assets a company has, the less debt, the greater its value, or equity. Total assets equals liability plus equity, or simplified, total assets minus your liabilities is what gives you your equity value. I hope this helps you to understand the balance sheet.